All right, welcome back everyone to the deep dive. We're the place where we grab those complex topics, the ones you pick, and really shine a light on the most fascinating bits today. We are diving headfirst into a world that's, well, it's super vital to our communities, but often kind of misunderstood. Tax-exempt organizations. Yeah, our mission today is basically to unpack the core rules, the details, and maybe even some surprising traps, how organizations get and keep that special tax-exempt status. We're focusing mainly on the most common type, the Section 501c3 charities. We've dug through a lot of comprehensive info, and we're going to break it down for you.
Exactly. And it's not just about, filling out forms. Understanding these rules is really key because it shows what these organizations are truly allowed to do and, maybe more importantly, what they're not allowed to do.
Right.
Knowing the why behind it all gives you a much clearer picture of, well, their impact on society and how they actually operate day to day.
Yeah. Absolutely. Because look, whether you donate money or maybe you volunteer your time or you're just curious about how your community actually functions, this stuff matters. It really changes how you might look at that local food bank or the museum downtown, maybe even your homeowners association. Okay, let's get into it. So first things first, the absolute basic question. What is a tax-exempt organization?
Okay, at its heart, it's a not-for-profit group that qualifies to be exempt from federal income tax.
Right.
But that term not-for-profit can sometimes throw people off a bit. It doesn't mean they can't make money.
Oh,
It
wow.
just means they don't hand out profits to, like, private owners or shareholders.
Hmm.
The big one, the most common type we're talking about today is that Section 501c3 charitable organization. That's usually what pops into your head when you hear nonprofit.
Okay, so that's the main category. And getting that 501c3 label, it's not automatic, is it? They have to meet some pretty specific requirements, like a test.
Oh, absolutely. It's definitely a process. The IRS lays out four main conditions. First one is all about their legal structure. So a 501c3 has to be set up as a corporation, and that includes LLCs now, or it can be an unincorporated association or even a trust.
Unincorporated association, what's an example of that?
Good question. Uh, think maybe like a group of neighbors who get together, maybe informally organize to raise funds just to keep the local library's doors open. That could work. What definitely doesn't qualify. Things like sole proprietorships, regular partnerships, or just an individual acting alone.
Got it. Okay, so structure first. What's requirement number two?
Number two is having an exempt purpose.
Hmm.
This is huge. The organization has to be organized and operated exclusively for one or more specific public benefit goals. The famous ones are, charitable, religious, scientific, educational
Which
purposes.
everyone knows.
Right. But the list is actually longer. It also includes things like testing for public safety, literary work, fostering amateur sports competition, national or international. But there's a really important catch there. Only if none of their activities involve providing athletic facilities or equipment.
Oh, interesting detail.
Yeah, it is. And finally, preventing cruelty to children or animals is also on that list. The key word, though, is exclusively. They have to be dedicated to those public good goals.
So it can't just be we generally do nice things.
Hmm.
It has to fit squarely into one of those boxes.
Exactly. Which leads nicely into requirement number three. No private benefit allowed. This is fundamental. The organization just cannot be set up or run to benefit private interests. That means like the founder's family or the board members personally or any shareholders if it's structured that way. Critically, no part of the net earnings, the money it brings in minus expenses, can benefit any single person who has a personal private stake in what the organization does.
That seems like the absolute core of being a charity, doesn't it? Ensuring the benefit goes to the public, not individuals.
It is. It's really the bedrock of public trust. It ensures that donations and efforts truly serve the mission, not someone's wallet. That's why the IRS is so strict on this one.
Makes sense. Okay, structure, purpose, no private benefit. What's the fourth one?
The fourth puts strict restrictions on political and legislative activities. And this is an area where organizations can definitely get into trouble if they're not careful. First part is political activities.
Yeah.
501c3s are absolutely forbidden from directly or indirectly participating in any political campaign for or against a candidate running for public office.
So no donating to campaigns, no putting out statements saying vote for this person.
Exactly. No campaign contributions, no public endorsements on behalf of the organization itself. But there's a key nuance here. Certain activities like voter education or voter registration drives are allowed.
Oh.
Yes, if, and this is a big if, they're done in a totally unbiased, nonpartisan way.
Okay, so they can encourage voting, maybe explain the issues neutrally, but they absolutely cannot push you towards one candidate or party. That sounds like walking a fine line.
It really is a delicate balance. Provide the tools for people to engage civically, but don't tell them how to vote. Then there's the second part of this rule, legislative activities, which is basically lobbying. An organization won't qualify for 501(c)(3) status if a substantial part of what it does is trying to influence legislation.
Substantial part, that sounds a bit vague. How do they define that?
Well, it can be complex, but legislation itself is defined pretty clearly. It means actions by Congress or state legislatures, local councils, things like bills, resolutions, that sort of thing. Importantly, it doesn't include actions by, say, executive agencies, courts, or administrative bodies.
Okay, so lobbying the EPA about a regulation wouldn't count under this rule, but lobbying Congress about a new law would.
Generally, yes. And attempting to influence legislation means things like contacting lawmakers or their staff or urging the public to contact them to propose, support, or oppose specific laws, or even just advocating for adopting or rejecting certain legislation.
Wow. Okay, so getting this status is clearly a whole process. It requires real dedication to these rules, which makes you think about the flip side. How does an organization actually lose this status? Because that seems just as important for maintaining the integrity of the whole system. This is where it gets really interesting.
You're absolutely right. Just like there are strict rules to get in, there are specific things that can get you kicked out, essentially. An organization can lose its 501(c)(3) status if it breaks any of those core rules we just talked about.
Yeah.
So, for instance, if it starts operating mainly for private benefit, maybe diverting funds inappropriately.
Like if the founder starts using donations for personal expenses?
It's exactly. Or if its political activities or its lobbying efforts become substantial, crossing that line. That's a direct route to losing tax-exempt status. Also, if it starts operating primarily to run a trade or business that is completely unrelated to its actual tax-exempt purpose, that's a major problem too. And here's a really crucial one, even if they follow all the program rules perfectly. Just failing to file their annual information returns, the Form 990, for 3 consecutive years can automatically revoke their status.
Oh, wow. Even a paperwork issue can do it.
Yes. These aren't just suggestions. The IRS actively enforces these rules to make sure the system works and maintains public confidence.
That makes total sense. Public trust is everything for these groups. But, okay, this brings up another question. What about when a tax-exempt organization does engage in some kind of business activity, like, a museum runs a gift shop, or maybe a university licenses some technology it developed? Does that income suddenly become taxable even if the main organization is exempt?
Ah, that's the perfect lead-in to unrelated business income, or UBI. This is a really important concept. Even though an organization is tax-exempt overall, it might still have to pay regular corporate income tax on income it earns from a business activity that's, well, not related to its exempt purpose.
Okay, so how do they determine if it's related or unrelated?
There's a 3-part test for UBI. First, the income has to come from an activity that is actually a trade or business. Second, the trade or business has to be regularly carried on.
Meaning not just a one-off thing, like a single fundraising dinner.
Exactly, more like an ongoing operation. And third, and this is the key part, the activity must not be substantially related to achieving the organization's tax-exempt purpose, aside from just providing funds. So think about a university. Its exempt purpose is education and research. If it operates a bookstore, primarily selling textbooks and school supplies to students, that's generally considered related.
Right, serves the students.
But if that same university decided to, say, operate a commercial pizza parlor in town, open to everyone, competing with other pizza places, the income from that pizza parlor would very likely be UBI. It's a business, it's regular, and it's not really related to education.
Okay, that clarifies it. But are there exceptions? Things that look like businesses but don't generate UBI?
Yes, definitely. The IRS specifically excludes certain activities and certain types of income from the UBI calculation. This is where it gets kind of detailed. For activities, things excluded often involve convenience or volunteer effort. Like that college bookstore example, it's for the convenience of students and faculty. Or, a big one, activities where pretty much all the work is done by unpaid volunteers. Think about that church bake sale or a car wash run by volunteers for a scout troop.
Ah, so if volunteers are doing the work, the income probably isn't UBI.
That's often the case, yes. Also excluded is the sale of merchandise that was received as gifts or contributions. That's your classic thrift shop run by a charity.
Makes sense. They didn't buy that inventory.
Exactly. Other exclusions include things like legally run bingo games, if state law allows only nonprofits to run them, certain convention or trade show activities, and even the sale of items made by disabled individuals as part of their rehabilitation program.
Okay, so lots of activity-based exclusions. What about types of income?
Right. There are also specific types of income that are generally excluded, mostly passive income, things like dividends, interest, annuities, royalties, basically, income from investments.
So their endowment earnings are usually safe.
Generally, yes. The idea is that nonprofits need to manage their funds to support their mission long term. Also, typically excluded are rents from real property, like renting out office space they own. Although there are catches there too, like if they provide significant personal services along with the rent, or if the rent includes a lot of personal property, like equipment.
Hmm.
Details matter.
They always do with tax law. Also excluded is income from research done by a college, university, or hospital, and usually gains or losses from selling property that wasn't held primarily for sale, like selling off an old building. It's fascinating how they draw these lines, isn't it? Trying to separate mission-supporting activity from just plain commercial enterprise.
It really is. What the IRS is trying to do with UBI rules is strike a balance. They want to allow nonprofits to generate some revenue in creative ways, but they also want to prevent unfair competition with for-profit businesses that do pay taxes on all their income. It really pushes nonprofits to think hard about how any revenue-generating venture truly connects back to their core mission. And there's one more special case worth mentioning quickly. Certain membership organizations, like social clubs or homeowners associations, which fall under different 501c sections, not C3, they're often taxed differently. Generally, they pay tax on all their income except for what's called exempt function income.
Exempt function income.
Yeah, that's basically the money they get from members' dues, fees, charges for the specific purpose the club exists for. So the dues paid by members of a golf club for using the course would be exempt function income. But income the club makes from, say, investments might be taxable for them.
Wow. Okay, so we started with the basics of what a tax-exempt organization is, went through the four big hurdles to become a 501c3, how you can lose that status, and then dove into this whole complex world of unrelated business income. It's definitely clear that running a nonprofit properly requires incredible attention to detail and a constant focus on that mission.
Absolutely. And maybe connecting this to the bigger picture, here's something for you, the listener, to think about. How do all these really detailed rules, especially the potential for UBI, actually shape the day-to-day strategic choices that nonprofit leaders have to make? What does that tell us about that sometimes blurry line between providing a public service and engaging in commercial activity in our world today?
That is a great thought to ponder. Maybe the next time you interact with a charity or a museum or any nonprofit in your community, you'll think about these rules, the structure, the purpose, the limitations. It might give you a whole new perspective on their work, the challenges they face, and just how dedicated they have to be to stay true to their mission. We really hope this deep dive gave you some useful insights and a much clearer understanding. Definitely let us know what other complex topics you want us to tackle next time.